I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for institutionaladvisors.com. Welcome to the show, Bob.
Yeah, good morning, Jim.
It looks like stocks and commodities have made a great rebound, but how long is that going to last?
Well, we look at things in December and January, things were very bleak. Most commodities were being pounded down, stock market was weak, and then that continued into January. And we noted that crude oil can often have a seasonal low in December or January, and thought that could guide the whole market. And things did become very oversold. You know, the technical measures for stocks and low-grade bonds like junk bonds and commodities, and sort of used spring, somewhere March to May, these various items could reach price levels and dynamics such that you'd start to look for the next exit on it, so which is what we've been doing. And you know, you go back to summer of 2015 when, using the New York Stock Exchange Composite Index, the NYA, we're looking for a big rounded or, well, I guess rounding top as it's happening, and then when it's over, it's a rounded top. And that did work out, and gave us the decline down to the dismal action in January. So what we have now here is, let's call it a rebound rounding top, where different sectors may not peak all at the same time, but it's been good action. You know, crude oil's gone from 26 to almost 47. You've had a nice rally in the base metal sector. Grains were slow to get started, but they did a quick pop. So these are, some of them are overbought, and so we'd look for gradual weakening in here. And crude oil's been going sideways for a week or so here now, but this week they've had some ups and downs. So what we have here is an opportunity to lighten up. If people were in the base metal stocks, the performance was great, and to start taking some money off the table on these things. And for the NYSE, it's Toppy. The other one within the stock group is the transports, and they had a fairly good rally to a few weeks ago, and then have been weakening. The importance of this group is that back last year, I think it was on Valentine's Day, we started watching the old Dow theory, which is the interplay between the Dow Industrials and the transports, and where the industrials had been doing well, the transports had not, so that's got us on an alert on it. We'd never used it before, but we did some special work on it and noted that the longer there was a divergence with the industrials going up and the transports not confirming with new highs, that the more you would get on the sell-off when it came. So the key failure in the transports was in May, and that then said to us that the bull market was over. So here we're looking at the transports, and it's just not all that strong. And then there was an image a couple of weeks ago of somewhere in Arizona where they're storing unused locomotives. The demand for moving rail is slowing quite a bit, and it had this image that looked like a few miles of track siding with locomotives stored on them. So that was quite graphic. With better commodities, you had a good rally for junk bonds, and that, of course, fed into the junk bonds outperformed treasuries, so you had a narrowing of the credit spreads, which is the difference between high-grade bonds and low-grade bonds, and that's been terrific. It's still going. And on previous years, we've talked about the seasonality of narrowing credit spreads, and it can go into May with the narrowing, sometimes into June. And if you're in a hot market for whatever, the changing of the spreads to widening is often a sign that speculation is going to come apart, and that was the case last summer when in June the credit spreads reversed to widening, and then in July we were looking for a breakout on the trending, and we got the one, and then the second one might have been in late July, but it came in early August, and of course that's what pushed off the problem with the Shanghai market, and then everything else came down. But so we've got very good narrowing on now, but it's been going sideways for the past week, and it's not really narrowing anymore, but it's not reversed to widening. That could take some weeks yet, but I noticed the other day that two of the big houses, Goldman Sachs and Prudential, were both recommending buying low-grade bonds, junk bonds, and that's a bit scary to recommend it going into the seasonal best for these things. So what we're going to do on this one is watch for the spreads to start to widen. Oh, the other thing is on the banking sector, it's been helped recently with the yield curve, which is in the treasury market, the difference between longer-term and shorter-term maturities. And for a number of months here, the curve was helping the bank stocks, and for the last week, that's turning to where the direction in the curve is not good for bank stocks. So we'll watch that one. And that's what's actually got us going last July when we came out with the observation that most banks were nice widows and orphans short, and then the banks went all to hell. So we haven't uttered that statement yet, but let's just say for the financial stocks, the change in the curve is now kind of beginning to be slightly adverse for the bank stocks. The action in spread market is not yet a negative for bank stocks, but we're watching it.
We'll have more with Bob Hoye right after the break.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Bob Hoye. Bob, what's going to happen with crude oil? Some people have told me it's going to hit $60 a barrel this summer.
Yeah, it's very positive out there on crude oil. They're looking at a couple of things. I guess they're doing some analysis of supply and demand, but the main thing on crude is that it got down to 26, extremely oversold, at a seasonal low, and now it's fairly overbought, close to a seasonal high, and people are feeling pretty positive about it. You know, you go 26 to say 46. That's a terrific move, but you still have, you know, all of these tankers full of crude oil still doing figure eights out there in various oceans. And no, I'm content here to watch for the seasonals on these things to become effective, and that is possible in the next few weeks. I think it could go back down to, say, a 27 or 28 level and test that washout low. You've got a technological revolution going on in the oil game, whereby with the fracking, and there's many oil deposits around the world that can be opened up with fracking, and the way that seems to work is as the price goes up, the guys open up the fracking operations, and as the price goes down, they turn them off. So you're into a new regime for crude oil. It's not the old game. We used that a couple of years ago to point out what had happened to the basic pricing structure in natural gas, which was the first one to really move. But if you take a look at the oil stocks themselves, and we've mentioned this before, on the hit down to January, base metal prices suffered, as did base metal mining stocks. And the mining stock index fell to a quarter of its high. And on the same disappointments, crude oil plunged and the oil patch stocks plunged, but that index, the XLE, it only fell in half. So I take that as showing that there's still too much premium in the oil and gas sector for the eventuality of things going wrong, seriously wrong in the Middle East, but that is gradually being offset where all around the world more and more fracking operations will be coming on. So it's going to take a number of years, but crude oil prices, I think, is in a long-term bear market.
What about other commodities like food?
Food? Oh, yeah. We've had in North America the rise in winter, vegetables grown in the southern parts of the states, whereby weather, particularly in California, drought and problem with irrigation water and stuff like that. You've had a sharp price, and then of course that rise in the U.S., and then also that makes it worse when you had a 25% drop in the Canadian dollar. But you don't see any shortages. You've got CO2 gas increasing, atmospheric CO2 increasing. Let's say it's up to almost 400 parts per million, and there's been studies coming out showing the satellite coverage of the amount of green out there and the intensity of it, and plant life all around the world is growing. So, no, I think you'll get price changes, but I don't think you're going to go into any Malthusian shortages and stuff like that on basic food growing. Yeah, warm is good and CO2 is good, so for growing crops. But over on the precious metal sector, wow, that was the best rally out of the whole at Christmas time. And in November we were writing that it was possible that as that action bottomed out, it could be the bottom of or the start of a new cyclical bull market. And then when you've got things like the, a senior gold index like the Hoye going from 99 to 220 or whatever it was, good action. And that's very persuasive that it is the start of a new bull market. But hey, that's kind of overbought as well. It's been terrific, and a correction for that sector is due. But really think that this is early stages of a new bull market for the gold mining sector, and this is not necessarily based on some of the wilder estimates out there that gold can go to 7,000 because of zero interest rates, or gold can go to 10,000 as some other author writes because of the Fed is so stupid. It's just plain that for the last year or so, the price of gold has been really outperforming all the other commodities, particularly crude oil, which represents energy costs. So actually, the basics for mining gold have been improving because their costs are staying at a good spread relative to what they're getting for the price of bullion. So for a bull market for the gold mining sector, you don't need a forecast of a soaring price of in gold in dollars. All you need to have is the basics of the industry improving, which is their costs are low relative to what they're getting for the price of bullion. So on the long term, we think the cyclical bull market for the gold sector has much further to go. But on the base metal miners, for example, or crude oil, I think it'll go back down and test the lows of of December, January, earlier in the year there. And that will not only test the price, it'll test the nerves of the bulls too, I would expect.
Some brokers are saying you should invest in just a few key stocks now instead of the traditional diversified portfolio. Is that good advice?
Well, generally, if you're at the start of a bull market, it is good advice to have a number of sectors, and it's very difficult to choose the stocks that are going to be the best performers. But no, it would be underweighted in general equities and overweighted in the precious metal sector, with the understanding that they're overpriced at the moment. Modern portfolio theory has been around since the 1920s, and it insists that you stay long all of the time. And that's really not too good. We're in exceptionally volatile times because you have a bunch of naive policymakers. Trust me when I say naive, I've chosen the word carefully. These guys have a firm grasp of theories. The problem is the theories are not based upon reality. They're based upon Keynes's imagination. And so their attempts to make for a better economy have made the financial world wild. And over the decades, for example, since 1600, since 1700, in England, you had a central bank, and very rather sophisticated financial markets. And the highest yield when you're in a secular rise in interest rates was about 6%. And then you go to 1981, when the Federal Reserve had spent 20 years trying to lower interest rates, and they went from 3% to 15%. Interest rates in the senior economy and the senior currency had the highest ever was 6%. So they get them up to 5 and then up to 15%. And then you come into a long secular decline in interest rates where you're down to, 2% for long governments. And that is also absurd. On previous secular lows, when the senior currency, then sterling, was gold back, the low would be around 2.5% or 3%. So the financial markets are distorted, but the same old 3 or 4 year business cycle prevails, and the same old swings in financial markets continue, but with much wilder swings from overbought to oversold. So the naive policymakers who had a theory that they could stabilize markets and prevent sharp setbacks in the financial markets, which back in 1913 they thought caused recessions. And they thought if they can prevent the setbacks in the financial markets, you won't have recessions. So, it's all been nonsense. Somewhere, probably within a decade, some serious researchers are going to get the forefront and say, look, this is absolutely preposterous notions. How could people have been so gullible to believe that a self-selected committee can manage an economy? It's absolutely bizarre. But anyways, we'll leave that for our listeners to consider over the weekend.
Bob, thanks a lot for chatting with us.
Jim, good to be with you, and have a good weekend.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our YouTube channel is Talk Digital Network. You can forward questions or comments for Bob to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.